Have you thought about electricity as an asset class? Most people in Canada, when they talk about energy, they will talk about oil and gas, and they will think that oil and gas is an important component of the modern economy and the way things are going. But the world is moving very, very quickly toward electrification because of data centers, because of electric cars, and so forth. Have you thought about using electricity as an asset class in your portfolio, both for risk reduction because of the very, very clear demand everywhere, but also from a return enhancement perspective because demand is growing so quickly? This week, we'll be talking about electricity as an asset class. You won't want to miss it. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. My guest this week is Michel Snager. He is a portfolio manager with Ecofin investment team at Red Wheel, where he heads the Ecofin Next Gen Power Strategies program. Prior to Red Wheel, Michel was at Goldman Sachs and at Bain & Company. He holds an MSc in Business and Engineering from Brussels University and is a CFA charter holder. Michel, how are you today?
I'm great. And thank you, John, for having me today.
So we're going to be talking today about electricity and energy. And that's something that a lot of people really don't think about very much when they do their investing. And they don't think of it as being something they can invest in as a tangible way. So what's a good way of looking at electricity infrastructure from a portfolio perspective?
Yes, John, if you look historically, electricity has not been represented as an asset allocation category. Investors have looked at energy to allocate, but not to electricity. And the reality, if they had done that in the last 20 years, allocating to energy, but not to electricity, they would have underperformed substantially, both in the North American market and in Europe. Energy, oil and gas, and energy more broadly has underperformed utilities and electricity in particular. And so this is in an environment where electricity consumption in developed markets has been stagnant. And so the idea here is that we are really at an inflection point in electricity demand. And so if we think the next decade or the next 20 years, the risk of underperforming by not having exposure to electricity is even greater than it has been in the last 20 years.
Wow. Okay. So that's a good reason to own it. And are there other pros and cons that you can perhaps identify so that we can get a sense of where it fits in a portfolio?
Well, look, the advantage of the space is it's unusual characteristics in the sense that it's defensive. If you think electricity is a subset of utilities, it's defensive in the sense that it's long duration assets, infrastructure assets primarily. It's a lower beta than the market. It tends to be perceived as very defensive, so kind of protecting you in a down market. So the negative, in a way, in the perception is that if you believe that we have a company that a market, that keeps growing and running on beta, it will keep underperforming. The difference with focusing on electricity within utility is that there is a lot of secular and structural growth because of the growth that we are seeing in the underlying demand coming from transportation, like electric cars, like the data center. So you have an unusual combination of lower beta, but that doesn't mean lower growth. You have that interesting combination for investors where they can participate in the growth, but they have a much less volatile, segment to invest in.
So I think that's a good way of assessing how investors might want to look at it from a portfolio allocation perspective. It sounds like you're saying it's both defensive and growthy, and that it's got characteristics of both, and that a lot of people already have energy in their portfolio or a lot of people already have utilities in their portfolio, but they don't think about energy in the sense of being electricity. And I know that one of the things here in Canada, because you're in Europe, but one of the things that we talk about here in Canada is that our new prime minister is talking about Canada being a global leader in both conventional and green energy. And we always, certainly when I speak to people in Canada about energy, it is almost always about conventional. And that is one of those things where there's no doubt, we can try to do the transition from one to the other, But a lot of people seem to not understand that we need so much energy because of consumption going up, especially in the developing world, that we pretty much need all the energy we can get from wherever we can get it because there's so much increase in demand. Um, let's talk about public versus private because a lot of the time on this podcast I talk about the benefits of having private investments, but you work in the public space, and a lot of investors use private structures to invest in infrastructure, which is another way of looking at energy. Why should they consider using public companies as a way of getting access to that subsegment of the market?
Look, I think that aside from the advantage of having sort of liquid assets versus, not illiquid assets, specifically in this case, one is you have a diversification geographically and from a technology perspective. And given the geopolitical development, the change in regulation, you don't want to be prisoner of one location, one technology. Imagine having too much in US offshore. That's pretty much dead for the foreseeable future. Or having, assets that are depending on Russian gas, you're really in trouble. So you want to have that flexibility of moving around the world depending on the changes in the environment. The other aspect is that you get very attractive returns in the public market. We invest, we have been investing for decades in this sector, and you can deliver very high, similar return to the private in the private side, but very attractive returns that are superior to the market in many cases. But maybe the key point for me, I would say, is that you see a lot of private equity fund coming into the public market and buying listed renewables, listed electricity developer and operator. So in the decision of build versus buy, they're obviously building new, but they're also coming to the public market to buy, which means what? Which means that they're ready to pay a premium to the valuation you have in the public market because valuations are very attractive there. So if you're an investor, I'm not saying you don't have the private, but consider having the public because you want to be the target when there is an M&A and getting the premium rather than having to invest at a premium in a private fund.
So if you were to offer some advice at a very high level with regard to how much to allocate toward public and how much toward private, how would you divide that pie and why?
Well, it depends of your tolerance for volatility. The advantage obviously of private is you don't mark to market every day, which a lot of investors like. But if you believe that markets will keep, running, private, will underperform the public market. So I would have a sort of a balanced allocation, but maybe specialize also what you have in the private that can complement what you can find in the public rather than replicating the same strategy across the two.
So maybe mixing and matching based on your profile for liquidity and risk and maybe different perspectives on things, which is oftentimes what I say as well. So I'm glad to hear there are other people who see the world, more or less the way I do. I find that comforting. So that's great. Let's talk a little bit about one of the elephants in the room that a lot of people in finance don't want to talk about, and that's Donald Trump. We in the world, throughout the world, have to find a way to deal with his administration. And I know that European governments are dealing with their own challenges. And we have to find the funds to drive decarbonization. And a lot of what is being done to decarbonize in the Western world is being actively resisted in the United States. And that is a challenge for the rest of the world. Has the world lost momentum with regard to a move toward decarbonization, or are we just in a lull right now?
Well, so look, I'm not doing any politics, right? I'm
All right.
really focused
I'm
on.
not asking you to.
No. But this is really about what we do in terms of investing. So I think there is a need to put things in perspective. If you look at Trump term number one between 2017 and 2021, the sector, renewables, electricity, did really, really well, despite the public perception. Because remember that already back then it was exiting the Paris Accord and all of that. So it was already a very negative rhetoric coming from the administration, and yet our sector did really well. And if you look at last year, despite the second term of President Trump, we did really, really well. So I think that we need to, dial down the rhetoric and the headlines and really look at what's happening bottom up, because at the end of the day, that's what is driving our stocks, and this is what is driving performance and returns for investors. And the reality is the story here is really the demand of electricity that we talked about just earlier. This is not going away. This is just accelerating. We have data center demand that is really accelerating. You have electric car penetration primarily outside the US, but even hybrid in the US are taking market share. And it's really accelerating in countries like China. So you have a situation where the hyperscaler in the US are saying we need more electricity and we need it faster. And the only energy today that can deliver fast electricity is renewables. And medium term, you're going to have time to add gas and nuclear, but it takes many, many years. And today, in the interconnection queue to add new capacity, about over 90% of new supply capacity is renewables. So, this you can't get rid of it. You need it, and you need, as you say, all of the above. We're going to need renewable. We're going to need some non-renewable capacity as well, depending on location, depending on local circumstances. But this, I would really dial down the focus on the rhetoric and really focus on the underlying drivers. And the underlying drivers are very, very strong for electrification, as you said.
From a purely economics perspective, the metaphor that I know has been used in the past is the comparison to when there's a gold rush. Right now, there is a rush toward AI, and part and parcel with the need for AI. A lot of investors are saying, I want to buy AI stocks, but they need electricity to actually empower AI. Similarly with gold, 150 or 200 years ago, people really made their money by selling the picks and shovels. Not many people actually found gold, but everyone needed the infrastructure, picks and shovels, to actually look for the gold in order for whatever nuggets could be found to be found. And I think this is a similar sort of story where, writ large, you're actually buying the things that are required to get the things that you want. And whether you get them or not, you will absolutely positively need to have the energy in this case in order to move forward to try to build that AI and to build the economy of the future. Okay, so let's talk about Canada now. So we're here in Canada, and we've already spoken about the challenges in the US. Here, there's a lot of talk about moving toward a more resilient economy that is not as dependent upon one country. In our case, over 3/4 of Canada's trade is with the US. And that's not only with regard to tariffs, but it's also with regard to intellectual property and rule of law and a whole number of different things. And again, I understand that you don't want to go into anything that is hardcore political, but how would you say having a clean energy, a clean source of supply plays into the strategy of being an independent, sovereign country that has the ability to be resilient in spite of whatever the world might throw at them?
Yeah, look, I think it's a very, very important point. If you think about the evolution of renewables as a source of energy, if you go back 10 to 20 years, the real reason why it was started to be adopted is really a view on climate change. That was the primary reason. Why? Because it was very expensive at the time, right? So move on with time. The second reason why renewables started to be deployed in a greater scale was the cost, right? The cost curve really collapsed. Battery prices, to give you an example, have gone down 93% between last year and 2010, right? So over 14 years, down 93%. Solar costs have come down dramatically. So the decision was really an economic decision after being a climate decision. But what has really changed, especially in Europe, but that has really, broadened the perspective globally, is what happened with Ukraine and the war with Russia. and the lack of access or the reduced access to lower willingness to access, to buy Russian gas. And what that has really changed the mindset that energy security and independence were of strategic importance for countries to really be independent. Otherwise, you're not really independent. And so what you're saying about Canada is the same. Having more renewables in your energy mix is making the country more resilient, more independent, which is very important strategically, but also, as I have said, from a cost perspective, it's not expensive. It's actually going hand in hand with your other objectives, which, from your prime minister is important from a climate perspective, is certainly important from an economic perspective. And then, the third sort of, pillar there is the strategic importance.
Right. And one need only look at Germany to see how dangerous it is the Germans decided that they were going to be turning away from nuclear energy, another form of energy resilience and independence, in order to try to move toward green things. And then when things fell out with Russia, they didn't really have a plan B. And it's important that nation states, especially as a new world order evolves, have secure supply, because it's the sort of thing that will absolutely become more important going forward. And I think a lot of people don't think about when they think about investing, they generally think about the world as it has been in the post-World War II era. They don't think about, okay, well, what should we be investing in given that the world order has now changed? And the paradigm is still one of investing the way we always have, because that's all we've really ever known, which is Bretton Woods and globalization and freer access and costs coming down and supply chains being eased up. Well, all of that has been thrown into reverse in the past number of years. And a lot of people are still acting as though nothing much has changed, and a lot has changed. And I don't think people's investing attitudes have necessarily kept pace with what's going on when they read the headlines. And that's part of why I wanted to ask you, without getting into politics, why I wanted to ask you about that perspective. All right, let's see if we can wrap this up. Michel, if it was up to you, the podcast is called Make Better Wealth Decisions. And if it was up to you, what advice would you give listeners with regard to how to make better wealth decisions?
Well, to close the loop on where we started, I think it's essential for investors to think about allocation to electricity when they think about allocation to energy. When electricity was 10 or 20% of the energy pie, it was okay to disregard it. It was marginal. We are now walking quickly through the 20% and going to 50% because electric cars. If I had told you a few years ago that China would sell more than 50% of their cars as electric cars in 2025, and all the electric cars sold in China are more than all the cars sold in Europe last year, and nearly as many as all the cars sold in the US last year, right? This is what's happening. If I was telling you that one of these NVIDIA chip has the same consumptions as an electric car, okay, and then those data centers that all the hyperscalers are talking about, from Meta to Microsoft, that they want to build, each of those data centers in terms of electricity consumption is the same as the city of Calgary, by one of those big data centers. So it's real. It's not, don't believe me that it's going to happen in 20 years. It's happening now, and it's happening now at a speed that we have never seen before. So we are really in a super cycle in terms of electrification. And so for you investors, it's essential that they find a way for their portfolio to have exposure to that, because it's going to be a bigger share of the pie, and therefore it should be a bigger share of their portfolios.
All right. Michel, thank you so much for your time today. It's been a real pleasure, and it's a real eye-opener speaking to you, because you talk about things that almost no one is talking about. And it's really great to see someone out there in the field moving the world to the future with honor and integrity, but also with a real clean sense to the bottom line, and making sure that it all makes sense with regard to basic investment principles. So thank you for your time today.
Thank you very much, John.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website,